Hi, everyone, and welcome. My name's Bree Hurst from the Onspring team, and today we are going to be going through our webinar, COVID Long Hauler Symptoms in Your Supply Chain. I have Eric Evans with us today, who's from the Rapid Ratings team, and he's going to drive much of the presentation today. But of course, like any webinar, we always have a few housekeeping items before we get started. One, all lines will be muted except for mine and Eric's. You guys will be forced to listen to us. But hopefully that's a good thing. Hopefully you'll enjoy it. This session is going to be recorded and will be sent out to all participants, whether you were able to join or registered and couldn't join. We'll be providing that to you. And then you'll notice on the right side of the platform that you have a chat and a Q&A option. So we actually have two ways for you to communicate with us today. One is through the Q&A. We will be asking you to ask questions throughout the presentation. Go ahead and put them into that Q&A. We'll save those questions for the end and answer them in real time if time allows for it. And then we also have a chat, of course. So I think it's always fun to go ahead and try warming up that chat before we get started, just so everyone feels comfortable with each other. So if you guys don't mind, I know Brenda Neely already threw some information into the chat, but go ahead and just kind of share where you're calling in from today. All right. Kansas City, very nice. Plymouth, Minnesota. Hi, Matt. Welcome. New Jersey. Great. We've got a good representation. All right. Well, I always appreciate that. Thank you for entertaining me. But feel free, like I said, if you have thoughts to share or anything that really piques your interest and you're just really excited about the content we're sharing with you today, feel free to chat about it with others that are attending. And then again, if you have actual questions you'd like for us to answer at the end of the presentation, go ahead and put that into the Q&A. So on to much more exciting things, which is what we're going to be talking about with you. So I'm especially excited because I think one of the most fun things in the entire world is taking data that you think is telling a certain story, but then looking at it a little bit closer and getting a holistic view about what's actually going on. So Eric from Rapid Ratings is going to take us through a lot of financial data today and really discuss what insights he's been able and his team has been able to find around COVID and how some of the short-term financial health ratings that you might be seeing from some of your suppliers might not actually be telling the full story, right? So that's really important. So not only is he going to talk through some of that data with us, but also what that means for folks like you at your organizations as vendor managers, as risk owners. And then we won't just stop there. We're going to give you some recommendations. It's never good just to talk about a problem. It's better to say, hey, how can we go about solving for this? So really excited to go through this content with you guys. And like I said, my name's Bree. I'm from the Onspring team. Many of you are probably familiar with Onspring, and if you're not, we're a cloud platform that's leveraged to automate your governance, risk, and compliance programs. And ultimately, what does that even mean, right? Well, we do heavy lifting so that you can focus on more strategic initiatives within your programs. So it's just like we're doing today, really giving you the time back into your day to focus on, is my program, how I assess risk, really answering the questions that I need to answer so that when the big crises do happen, I'm really well prepared for them. So I'm going to hand it over to our expert, Eric, and let him introduce a little bit more about himself, and then we'll dive into the content.
Awesome. Well, thanks, Bree. Appreciate it. And thanks, everyone, for attending today's webinar. And a big shout out to Onspring for obviously organizing it, inviting me, and Bree for hosting. So appreciate it and everyone's time. So we are, in terms of who I am, I'm Eric Evans. I manage our partnerships and alliances at Rapid Ratings. And I've been with Rapid Ratings about 5 years, and I've been involved with data risk and compliance for the last 20 plus years. And so working at companies like Edgar Online and Donnelly Financial Solutions before I got to Rapid Ratings. So currently I also co-chair the Continuous Monitoring Working Group at Shared Assessments and also sit on the Solution Provider Advisory Council with ISM, the Institute for Supply Management. So we have a lot of good conversations there with the members and other providers. So who is Rapid Ratings exactly? We're a SaaS-based algorithmic system whereby we analyze and rate the public and private companies that are out there from a vendor risk or supply chain perspective by providing a predictive analytic that we call the financial health rating. Analogous to running what I call an MRI or a CAT scan on the financials. And in our case, the CAT scan is our model. And so we have 24 different models that really packs the predictive power. So we kind of see what others don't far out, because again, companies are not going bankrupt overnight. They're deteriorating over time. And so our models really help produce that accuracy. And then we have global coverage, and we reach out and curate the private companies from over 150 plus countries. So we really go out and get those financial statements so that way our models can run more effectively with those inputs. Some of our clients in the upper right, as you can see. I am trying to switch the slides. So sorry. Let's see. Here we go. All right, sorry about that. There we go. Oops, backwards. My fault. So, as we know, we've seen a lot of headlines out there with supply chain. So, it's in the news left and right. Vendor risk, supply chain risk, third party, really prevalent. And so we're going to talk right now about kind of where we've been with wave one. So what happened to companies and liquidity in wave one? And so that's really, coming into COVID, 2019 and into 2020. A lot of triage, firefighting, companies scrambling, right? Putting together war rooms or teams. If you didn't have something in place, you scrambled. Lots of supply chain risk. And resiliency has been, really front of mind, and really becoming a board mandate. Government intervention, right, with two big elements around all the PPP funding and support in the financial markets by keeping interest rates low. You had the government bond buying program, which creates more liquidity and reduces liquidity from being pulled out of the market. And so you had the corporate pandemic and supply chain crisis responses. And then, what we're talking about today is some of that liquidity has really masked the deterioration at many of the companies because they have bolstered financial health now due to some cash infusions from the pandemic. So some things we've learned. So some 5 lessons of financial behavior during a pandemic. 1, our clients increase their coverage to really better understand the underlying issues by including additional suppliers or vendor tiers. If they were looking at direct vendors, they went and looked at indirect. Some companies that focus on just indirect, went down tiers. Also, vendors, looking at the vendor's vendor, especially if they're critical or sole sourced or preferred. So really going downstream was important. Also, too, they reviewed private company financial statements, which are typically more volatile during tough times, and that's really our value add. And it was really about reviewing the frequency. So we actually helped our clients by providing pro formas, back in 2020 in that March, April timeframe before financials were released. We were able to get pro formas from those companies. We also did some stress testing scenarios. So we were able to decrease revenues we did 15% across the board. And in some cases, then we did another stress test where we went deeper for different industries. So obviously we know transportation, airlines, oil and gas got hit, they really went down by 25-30%. And then we also launched our FHR exchange for companies to be able to supply their financials and have our clients invite them in, and they could share it with many. So that was another way to kind of increase the coverage.
Eric, I have just
Yeah,
two clarifying questions or
absolutely.
things. One is on that last slide, increase coverage to better understand underlying issues. Can you just tell us a little bit more what you mean by increased coverage there?
Absolutely. So they either looked at a subset like critical vendors, and then they may have gone deeper or wider or broader and said, okay, I don't want to just look at the criticals of the criticals, but maybe all the criticals, or maybe it's all the tier twos, or dipping their toe into tier twos, or even going to tier threes and saying, you know what, I'm going to expand, my lens and just go wider or deeper, whichever way you want to look at it. And if they were focusing on just, the ones they produce the most spend with, obviously nature of criticality, what's important to them, they just cast a wider net because of all the things happening out there, with especially particularly COVID, with the deterioration globally.
Okay.
And I think that also a factor of that was the pandemic kind of went from China to Europe to the US, and so that also some clients looked at companies in China right away, and there was a lot of companies hit in China, and then Europe, and then into the US.
Okay, thanks. And then my
Sure.
other thing, I'm dying to know, and you probably get this question a lot, but how do you go about getting the financial information from private companies?
So the Sopranos right now. We basically through people process technology, we have a team that speak natural languages and various languages like Mandarin, French, Italian, Portuguese. So through people process technology, we're reaching out directly to those private companies and talking to CFOs and controllers that the program's not punitive, that it's their client that is asking for this, and exactly telling them exactly where the data is going. Because one thing we don't do is take the data and then share it with everyone, because then we would not be as successful. And so obviously this is very private for private companies, and personal or private in the sense that it's locked down, secure. Nobody wants us to deal it out like a deck of cards, so to speak.
Awesome.
Thanks. Any other questions?
I don't think so.
Okay, cool. So the other thing that was really good lesson takeaway is that really helped foster an increase in vendor supplier collaboration by leaning in to ask the right questions. And so, understanding the short-term issues versus the long-term issues is really key. And so asking those right questions, about the issues coming out of those financial statements. So it could be operating costs, it could be, liquidity and cash, it could be, sales ratios, a number of things that can go haywire, or spot trends. And so having that vendor risk team really kind of lean in and help, get in front of it by asking key questions, kind of like on a quarterly basis. And then 4, improving the vendor working capital, because a lot of our clients are, Fortune 500s and, global multi-conglomerates. So they wanted to help their vendors improve by reducing the days payable outstanding to the vendor or reducing the days sales outstanding. So they adjusted payment terms accordingly. Maybe they wanted to, extend those payment terms or get them paid faster, in the sense is what I'm saying. So really interesting tactics. And the last lesson is other tactics have been spot buys if it's manufacturing. Could they buy raw material on their behalf? Can they do a capital investment? And in some cases, clients provided additional resources by sending people on site, right? Help project manage, what's happening, especially like with assembly lines or manufacturing plants, getting people there fast and quickly if they needed that. So in terms of corporate debt, so there's a lot of talk of increasing corporate leverage, which, this chart goes back to, the numbers are a little small, but it goes back to 1960. So this is all the corporate debt that's out there. It's bonds and bank loans, alternative credit, and these are Fed numbers that represent US corporate debt. So we're kind of bringing it up, basically the bottom line is that you can see the slope of the curve. It's gone from like 6 trillion to 12 trillion in just the last, 10 years. And so by keeping interest rates low, more companies have borrowed because the cost of capital has been cheap. Pension funds, in a sense, had to go down the credit spectrum to get higher level of return. So what happens there is they tend to invest in riskier companies, and their bonds that correspond to those risky companies to get more yield. So companies increase borrowing, and there's lesser restrictions on borrowing them. So cheaper capital, less oversight, and fewer triggers that raise flags when those companies are under duress creates, a funding environment. Most companies won't fail due to financial reasons if your financial reason is a bankruptcy or default. But really what we're saying here is that most people haven't managed risk in a really down market. And so that's, really what's to come. So we have a little more data, as Bree said. So we're going to kind of go deeper under the hood here, tell you what these numbers mean. So highlight a few things here. We took two industries, transportation and autos, and we broke it out both between public and private companies. And you'll see here we broke it out with our average FHR score called the financial health rating, which flags short-term default risk, and then the average core health, which is really fundamental to the company and the long-term strength. So important to note those two signals and how they kind of intersect and correlate. The other big thing is that, private companies tend to be smaller. They have less access to capital than public companies, and they're not as nimble. Yet private companies can change very quickly than public company ones. So they have more agility in that way. So what's kind of noteworthy here is that transportation companies, autos, as you see circled, the public sector remained relatively flat in 2020, beginning of COVID. They rebounded in the first half of 2021 from an FHR perspective. And then privates, just click on that. You can see, while also improving their FHR, their core health has deteriorated. So again, that short-term score kind of, popped up, and the long-term is still not looking well. And so with transportation during that time, public and privates, the publics dipped and improved, and the privates have improved, kind of popped up, and then came down a little bit. And then let me go to this one, where we have the two elements of change in debt and average change in cash to current liabilities. And so, what does this tell you? In the short term, companies are less risky than they were. And, fundamentally, from the core perspective, that core health, transportation companies have, the pricing power and have done quite well due to supply and demand. So when we look down into the autos again, and let's see, we are, right down there. You can see that is a negative. So when we look down into the autos, the public, the average change in cash to cash current liabilities and how relative cash is, there's 56% more cash So increase cash by raising or spending less. A company might be putting a capital project on hold. So it may not be that they're raising cash. They may have stopped, a capital project. So, the cash has gone up. And then in terms of in the long term, the autos have gone down because they're starting to begin to burn through that cash. So you'll see increased risk in the short term as well as the long term. So really important data that we're seeing, that really shows some highlights, what we see and some trends. And so to recap, we took another industry, the semiconductor industry, because it's such a hot industry. It's basically the semiconductor industry is healthy due to all the demand. We looked at industries that the semiconductor industry sells into. There's 31 of them, that's on the right, but only a third of them have seen the core health drop. The industries that are in their supply chain downstream on their customer base, again, only a third have dropped. This could shift, though, as we know, as more things increase in cost, and then inflation. We know inflation can impact the buying. So when we look at the semiconductor industry with the smallest companies, so on the left, on the bottom, what's really noteworthy, these companies have revenues of $50 million or less. That group had the biggest gap between core health and financial health. So again, financial health rating is the short-term score, core health is the medium-term score. The FHR score was higher at 60, but the core health was lower at 40. And so that's a big gap of 20 points. So those are some of the things that we saw looking at the data. So now, kind of really that wave 2 that we're kind of in now, companies will be influenced by all of these factors, supply, demand, the capital markets that I just, talked about, supply chain issues, with hiring more truckers, clearing of ports. Some risks are more obvious than others, like ESG, financial, or cyber. Private companies are going to play an increasing role. We're going to see 3 types of companies really in the future: thrive and grow, fail and survive, but with problems. So let's look at some other risks here. And from our perspective, financial health and financial risk really does underpin all these other risks. So what's important is to understand from your vendor's perspective, how well are they managing their business? What decisions are they making? And especially for private companies, since there is less scrutiny and they're much more volatile. So if you're not rating them, you're not going to know enough to ask the right questions. So what type of decisions are being made, right? And so when we look at financial risks, you can see it really does become a foundation where all these other risks intersect. And so we did some correlation studies a couple years ago where we took financial risk. Oh, there's Bray. And so we, what was really noteworthy with our clients' data is that companies that were risky financially, they were more than 2 times likely to ship a defective product and almost 2.5 times likely to ship late. So that really showed us some things that, or confirmed our suspicions that when a company is risky financially, there's other things that can happen. And so they may not be able to invest in infrastructure. Maybe they can't fund cyber risk, even though cyber risk is really important today. Or can they keep up with cyber risk? We know cyber risk is a heavy investment. So you've got to be able to have the funding to keep up with that. But then you also want to innovate, right? You got to have quality and delivery. And then now sustainability is pretty important to those manufacturing companies that are out there, right? So it's just a matter of trying to keep all of that under one lens and looking at it.
So, Eric, I'm going to ask some questions that came
Sure,
in,
I
even
love
though
it.
I said I wasn't going to.
No,
But
I like it. I like it.
I think because ESG is a hot topic, I think for some have come in. So, in mentioning that, and it's also timely because you and I were just chatting about this before we got on the webinar, so it's perfect. Can you talk about a little bit more around ESG? Are you tracking, or is Rapid Ratings tracking any ESG data right now? Or how are you seeing ESG data being used in workflows to optimize supply chains?
Yeah, so we know particularly around manufacturing companies, sustainability, ESG is pretty important. Obviously, different mandates, especially in Europe, and now the U.S. Jumping on with carbon emissions and things like that. So we are strictly financial, but we are complementary to sustainability. So companies are trying to look at all these risk pillars, including cyber, next to each other, and give it a proper rate. Or roll it up to a scorecard, depending on what they're what's important to them. So maybe with financial risks, maybe they'll have a higher rated um, you know input to the scorecard, or lower it depending on if the company is healthy or not. So depending on what's important to them, we haven't done any correlation studies yet with ESG, so it will be kind of interesting if we do find that.
Mm-hmm.
But we're very complementary, and the fact that, like I said before, if you tend to be deteriorating financially, you may not be able to fund all of those programs, or maybe you have to pick and choose which ones you're going after. Is it compliance? Obviously, if you're a manufacturing company, you've got to make sure you're not dumping something into the woods or into the lake, and things like that. So that quality and control aspect. So ESG is pretty important, but can they kind of keep up with that if they're unhealthy financially?
Mm-hmm. Yep.
So some more pie charts, or some nice colors to look at, whichever way you want to look at. But so just talking about, again, all of these different various categories that companies have to make investments in. You've got R&D, you've got compliance, you've got health and safety, product, payroll, of course, right? We all want to get paid, cyber, capital. What happens when a company has problems financially, and their core health is degraded or deteriorates? Or they raise the money and they burn through it. What's one thing that they can't cut? In our case, it's probably cyber, right? We have a lot of banks as clients. We are not going to cut our cyber program. We're we have data in the cloud and all of that stuff, and really trying to adhere to proper mandates and compliance, and really a good cyber hygiene. But some of the other things that could be cut would be quality control, R&D. Obviously, if a company wants to cut payroll, they could, but in our case, we didn't do that. So the point here is that some costs are not variable, right? They're fixed. And so, like in our case, like I said, cyber is kind of fixed. So what could suffer, and that's the point here as well, is that some companies may not be as innovative if they cannot put the money into R&D. They may not be shipping a quality product if they don't have enough money to fund quality control, or health and safety measures. Moving along, we also took a look at, because it's very interesting, kind of where we are. So a few more points is that we took a look at weekly flows, and we look back to see that we may look back in a few years from now and say, was this the early signs of some volatility or contraction in credit? And we know the markets are volatile. Bitcoin pricing over the last few months has come down. Like I said, this really shows a weekly depiction of the last few months where people are taking less risk and they're taking money out of the market. And so most private companies borrow from one or two banks. And when banks get conservative, they can start to pull credit lines and contract really fast. And so, just something to think about when you're looking at risk. You have to take in, some of this other stuff here. And so the other thing is, this is the bond outlook as of 2018. And so we're going to kind of compare 2018 to now. And so, this is where, there's data available. And this is the maturity calendar of bonds that needed to be refinanced as of 2018. There was about 175 billion in 2022 back then that had to be refinanced. And then when we flip it to today, you can see that, 2021, it came down in 2022. And, why is that? There's a lot less funding required, especially over the last year where they've raised money for a year or two. And so what did they do? They've kind of kicked the can down the road for 2 years. So, cash to current liabilities increased, current liabilities have decreased. And if you go out 6 years, there's a lot of funding that needs to be refinanced or repaid. And so there are more years at the higher level. And then when you look at, kind of double that in 2023, and this is just kind of one segment of it. And then we know interest rates are kind of edging higher. So it's all appropriate timing, and what happens with higher interest rates? Companies have to pay more money. And then there's a lower, segment of risk. There's a lot of risk in that lower bottom of companies that are riskier, across supply chains, especially the private ones. Did you want to say something, Rick?
Yeah, I was. I just
allows me to get a little drink. Yeah,
I Houdini in to ask probing questions, of course.
Sure.
So, yeah, I think since I know what's coming next in this presentation around the future state and silver linings and how we can really lean into financial health monitoring, I thought it would be helpful, after we kind of dove into that data, to just take a second to kind of put it more in layman's terms of like, why is this deeper look at financial health, especially coming off of or still kind of going through the pandemic, so important to the people that are managing risk today. So if you could just kind of back up a little bit before we transition into the great stuff.
Yeah, absolutely. I think basically the moral of the story is there's more risk coming than what's been taken previously, right? Companies are going into a period of huge pressure and a squeeze. Now, we don't know how big that squeeze is, if it's going to be a tight squeeze or a light squeeze. But if you look at the last 5 years versus the next 5 years, it's been the most accommodative market ever with lots of funding available. I think that's the moral of the story, is that when we look backwards, we know there's been a lot of easy access to credit and to capital. And it really masks what's under the hood. You have to go deeper. Otherwise, you're not looking, at what potential problems there could be. And so, running kind of a credit report or a credit check may not be enough, right? You've got to really go deeper. And so that's kind of where we come in, versus, how well does someone pay their bills? So we can get into that a little bit too.
Mm-hmm. That's great.
Yeah, let's see. Where are we now? Okay, so another headline. So obviously we had a crystal ball. I wish we had the crystal ball, but this is looking backwards. We know in October what happened, right, with Evergrande in China, and they missed, one of the big developers obviously missed a bond payment as stress spreads beyond the Evergrande crisis. So, very appropriate headline looking at all those bar charts. And then future state, so not to be completely depressing about the future, there are some silver linings. And so you can't eliminate risk, but you can manage it. And I think that's what we're saying today. That's what, vendor risk professionals, third-party risk professionals are trying to do. And you can't manage it if you don't know what that risk is. So kind of knowing there's a second wave, you can plan for it. And knowing these risks are connected is important so you can detect them earlier on, right? Looking at financial health, either short-term or long-term, looking at the core health, the fundamental, and then looking at the cash turn or how much inventory they're holding, all of those type of things. So, looking at obviously collaborating, continuing to build relationships. And then I really like the last one, prepare, predict, and protect by continuous monitoring, because obviously you want things to be more automated and pushed to you. And we'll be talking about that in a little bit, kind of how to execute that. So we have some more ways to lean into financial health monitoring. You do want to use up-to-date financial information early on to understand your vendor's short-term resiliency and longer-term viability before it's too late. So again, we use financial data as the input, not trade payment data, which is pretty key. That's also something that the OCC has said back in 2013, coming out with the OCC mandate for banks. You really should be looking at financial statements. So pretty key there.
Real quick, Eric, just to kind of interject on that one.
Yeah.
I think what we're seeing more as the potential here is, how do you leverage some of that financial health data to maybe bring to light automatically different changes that might be taking place at some of your suppliers. So rather than having to react to things, have it be more proactive, where you're setting notifications that
Absolutely
are automatically bringing that to your radar so you can respond to it more quickly.
Right, exactly. Actually, we were talking about this in the continuous monitoring working group the other day, that tool integration and operationalizing all of this data into your workflows is really key, because having it siloed or having data in separate systems, and same thing with groups have come together more to look at the data together. And so doing that with a combination of rapid ratings inside Onspring, we've got some good takeaways there to show you and kind of how to execute that.
And then, Eric, real quick, just kind of in the reverse of that, I think it could be interesting to hear how, before your customers start using rapid ratings, how are they getting financial data?
Good point. They're either Googling public companies. So that's, publics are a little easier. Obviously, you can go out on the internet and kind of look at, but not everybody is a financial analyst. What are they writing up about it? Probably not much. They're either ignoring private companies. Again, this is what our clients have told us coming to us. Or in the past, they've run a credit check, credit report, which unfortunately is too little too late, because it's looking backwards and not forwards. So it might kind of flag something in the month they're going bankrupt, and it's a little too late to mitigate risk. Whereas we get out in front of it quarters ahead, by using the financials. So they might just be doing throwing some people at it, or really one person running a credit check, but not on, nothing systematic.
That's perfect. That actually answers another question that we had come in, which is, how is rapid ratings different from a credit report or score?
Right. So that trade payment history generally produces a credit score, credit report, as well as firmographics, like how many employees, so it's not based typically on financials. So just like any of us on the webinar today can have a great FICO score, we can go get credit. It doesn't really tell anybody anything about tomorrow, whether we're going to default on that credit card or home loan or car loan, if they're not asking for our income and assets and liabilities and all of that stuff. And so companies act the same way, especially private ones. They're paying their bills all the way up until filing for bankruptcy. So that really masks what's going on. So they look good until it's too late.
They look good till they don't.
Exactly. So I think, let's see, that one was, learn that financial health leads risk into other control areas. So like I mentioned, we did the correlation study, some of the quality and delivery. You can really hone in on that as well. And continue to embrace the value and transparency to build better business relationships. What a tongue twister. Basically, that means you're collaborating with your vendor. You want to partner with them. I think I've heard that word partner much more over the last year because they really truly want to work together. Nobody wants to see a vendor, especially a critical one, fail. And so you really want to collaborate with them more on a quarterly basis. And, lean in. It doesn't have to be financial, doesn't have to be punitive. It doesn't have to be a negative conversation. And that speaks to a lot of the things that I spoke to around the lessons learned, that clients really found creative ways to help their vendor. And they only did that because they were able to ask the right questions and lean in order to, build a better business relationship.
Real quick on that last one.
Mm-hmm.
I think what helps when we talk about, really embracing transparency and building those really strong relationships is maybe just giving a couple examples or an example of what that actually can look like in practice. Is it a matter of the vendor manager like reaching out to the supplier when things change in their financial, like kind of tell us more about what you've seen, or how in an ideal world it would play out if that data is available.
Yeah, exactly. So particularly so with our kind of automated system and methodology with the tier bands, 1 to 100 score, 5 bands, 20 points each, high, very low risk to very high risk. So a company, when they teeter and go under 40, that's when they're very high risk. So I think what's important is not only when they become high risk, but if they go from, any type of level to a threshold that meets your criteria that you're uncomfortable with. So is it 5 points? Is it 10 points? Did they go from low risk to medium risk? Did they go from medium risk to high risk? Did they go medium risk, to very high risk? So looking at that throughout and understanding, how they dropped or changed can trigger that outreach or that deeper dive into, what's going on with the financials. And then asking those questions, you could copy paste them, put it into an assessment or a tracker, call them up, send it to them. Maybe it's an assessment feature in Onspring where you're sending it and they're kind of answering those questions. And so we'll show you later, this financial dialogue is a great audit trail, especially with the OCC, where you can ask these questions. But in those questions, you can really pick apart and understand. And I think that's what it is. It's looking at this more frequently than, every year and a half or every year. It's you might be doing this now semi-annually, or in some cases quarterly if they're really critical, or if they're high risk, you really want to keep a pulse on them quarterly.
I love that. And I think everyone will appreciate the questions that you provide in a couple slides here around how to go have that conversation with your vendors.
And yeah, that's a good takeaway for folks to get. And so we put those together. So I think we talked about this, but recognizing that collaboration is more critical, right? Asking those questions. So we'll get to those in a second here. And then this is pretty key. Nothing works unless you operationalize it into and embed it into your process. And so, are you using financial health in your sourcing, onboarding, continuous monitoring processes, or any of the risk domains? But, we're talking about financial health today, but where is your place of truth? What system? Onspring, you're using that data, for those workflows. And so, having it all in one place will show you kind of how to execute that. Some of the questions we put together, and this is what's contained in the reports that we provide, I won't read them all, but just like you're really getting in front of, like, do you intend, any equity issuance in the next 12 months? Exactly what are you doing? Do you have any venture or private equity backing? Is it a minority or control stake? Do you intend any asset sales in the next 12 months? So not that you have to be a controller or a CFO, but we break this all down into layman's terms in the reports, give you supporting questions and discussion points. And so one client, a CPO, coined it finance for dummies. So we would never say that to our client, but they said it to us. And so it's kind of nice that, it kind of is the Cliff Notes version to, understanding this stuff much better.
We had one other question come in.
Sure.
Eric, is what kind of coverage does Rapid Ratings have? Is it global? I think the answer is yes, it is, but I just want to...
It is global. It's more curated. So we won't rate, we'll rate a company in any country that we can get the data from that supplier or vendor on. So we have about 150 countries where we've reached out to those vendors, suppliers directly. So yeah, it's pretty much all over the globe, especially in China. We're really, that's our second highest country of coverage. And so we're really successful. So, getting that transparency, gaining that into the private companies is important. So what we do is we basically refresh every time somebody wants the private company view. We'll go out and refresh it for them. And so they're not just pulling stale data. It's not a database where you just go in and grab something from 2 years ago. For private companies, we really are going out and getting it. Even if we contacted the supplier last week, we're going to that supplier again to ask and confirm if anything's changed. And again, we're not resharing it with others unless they share it as part of the exchange. It's really a one-to-one relationship with the client. So how do you make this all happen? Again, operationalizing it, whether it's a sourcing, onboarding, continuous monitoring event, baking it into an RFX or sourcing event. One of our clients, or actually a couple of them, in the system of record, if no financials are provided or Rapid Ratings, that's a serious red flag. You can't even move forward to do business with that company. Because to them, that company, that vendor or supplier of theirs is hiding something. They're not being transparent. It's a no-show. It's a no-go because it's a no-show for the financials. So verifying the financial health rating upon onboarding. So what if you did the RFX event a year ago, you picked your supplier or vendor, you need to verify it again upon onboarding. Set up the continuous monitoring to automate all of this. We'll show you how the data is represented in Onspring if you're a client of both of ours. And so the whole point is to kind of go through this in a way that is systematic, using triggers, upgrades, downgrades, changes, assign it to a cog league, run the deeper analysis, the deep dive. Like I said, we're almost like a robo-analyst. Look at the FHR report, view the dialogue, collaborate, discuss the areas of concern, and then reporting, and then dashboards, mash it up with other data, because that's the view and lens you want to see. And we've got that screenshot right here, where the data and analytics are available in Onspring. So we're a technology partner. There's an API connector. And so you can bring your master portfolio of public and private company data over into Onspring, refresh it nightly. It's all automated, and view those financial health key risk indicators, get in-depth analysis of what we like or don't like, go deeper, and then be able to look at the quadrant analysis, and then look at the financial risk exposure over time. Again, today we've been talking about looking at the short term versus the long term, because those two signals are really important. Don't just look at the short term in isolation to the long term. And so here's some of the ideas or glimpse into some of the key risk indicators that you may want to look at, which are available through the API, which is kind of my best friend. So basically these data points can be refreshed, and then you can get the FHR report or financial dialogue report. If anybody wants a sample copy, just reach out to me. and you can get a copy of a public company. Happy to send some reports. There's my email address. You could email Brianna as well, and I can get them over to her. Any other questions? I know we had a number of questions throughout the webinar, but hopefully that was easy to digest and not too many numbers, but some important, colorful charts that really did tell a story around, what's been happening out there and where we're going.
Eric, I loved this presentation. I'm probably biased, but like I said, I'm a data nerd. I love thinking about ways to dig deeper and to see what the bigger picture or bigger story is behind data. So I really appreciate the concepts that you shared with us. I think the key takeaways are now more than ever, it's important to take into consideration the long-term data as part of your financial health rating of your suppliers. It doesn't have to be as laborious as maybe it is sometimes, right? There are tools out there like rapid ratings that do that heavy lifting for you. And then, I mean, we've kind of talked about it, but if you're using a tool like Onspring, we have that capability to not only centralize what you're already doing today in a platform like Onspring, but also bring in that data from a financial health rating perspective. So I don't think that there are any other questions that came in. So we were able to get those answered throughout the course of the presentation.
Cool.
The conversation doesn't have to stop here. To our attendees, if you guys have any further questions, dialogue, or interested in learning more about the financial heavy lifting that Eric's team at Rapid Ratings can do, please feel free to reach out to him. Or if you're interested in learning more about how Onspring can help with doing that heavy lifting, we are always, here to help.
Thanks, Bree. Appreciate it.
Yep.
Appreciate it. Yeah.
Awesome. Well, thanks, everybody.
Thanks, everyone. Yeah. Take care.
Take care.